Welcome to the stream. Thanks for tuning in. My name is Brandon, co-founder of Overseas DeFi. I'm also the head of education over there. And in tonight's live stream, we're doing it a little bit differently this week. I'm going to start doing the live streams on Tuesday nights rather than Thursday nights. But on tonight's stream, I want to make a comparison between traditional investing and portfolio structure compared to DeFi investing. As you might imagine, I've been doing DeFi for quite some time, and we've developed some pretty amazing and useful strategies around structuring our DeFi portfolio. So that's what we're going to get into tonight. I promise to break it down as simply as possible, but always feel free to stop me, interrupt me, ask any questions if I go too quickly through something, or if you want me to double click on something, by all means, interrupt me in the chat. I've got my eye on the chat over on one of these screens here. So feel free to do that. But I'm going to go over at least 2 to 3 different strategies that we can take advantage of in DeFi. And these strategies are just not available in traditional investing. You can't do this with your Charles Schwab account or your E-Trade account or anything in a TradFi way. These strategies are just not available until the advent of decentralized finance. And I'm going to demonstrate these different strategies and how they work as a way of showing that in DeFi, we're actually able to make money in any market environment. So it does not have to be number go up to make money in DeFi. In fact, you can make a lot of money when prices are crashing. And I'm going to highlight some of the strategies that we can use to do that. And the reason that prompted tonight's video and the subject that I wanted to cover, as you guys might imagine, I belong to several different groups. So on Telegram, on WhatsApp now. So I'm in different groups and we get to chatting about crypto and DeFi and investing and different strategies and all of that. And there's one particular guy in one particular group. And basically, he and I kind of got into it. And what he said that threw me off and compelled me to say something and try to educate him a little bit, which was kind of a frustrating process. But what he said is that I know how to do DeFi. I know how to provide liquidity, and these DeFi strategies, they don't work. They underperform compared to traditional strategies. And the funny thing is, the example that he gave for this underperformance had to do with some traders that he knows. Now, I don't know the validity of this story, but what he said is all of us have been losing money in DeFi, which that is not true, but we've been losing money with these DeFi strategies while these traders that he knows sold all of their Bitcoin at the top, okay, 120,000. They sold all their coins and then they just sat on their hands for 8 months and then they bought their Bitcoin back at 60,000. And this was the TradFi investing that this guy was comparing to DeFi. And I said, hold on a second. First of all, that is almost perfect market timing. If you give that kind of ability to any investor where they can almost perfectly call the top and almost perfectly call the exact bottom, of course, you're going to perform very well. And so what I said to him is, if you compare these guys, they sold their Bitcoin at 120K and then they bought it back at 60K. And now this guy was saying, well, now they have twice as much Bitcoin. Great. And now when Bitcoin goes back to 120K, they'll have twice as much. They'll have 100% return. And I said to this guy, if you give me a full-fledged, professional DeFi operator, if you give me that kind of market timing, I would massively wipe the floor with these guys. Because here's the thing. And again, whether or not you believe this story, the story is they sold their Bitcoin at 120K, and then they just sat on their hands for 8 months and bought the Bitcoin back at the bottom, 60K. Okay. The key there is sitting on the cash for 8 months. First of all, who has the patience to do that? Not many. But secondly, 8 months is a long time. And tonight, again, I want to elucidate some strategies for you where if I had that kind of market timing, if I had the foresight to be like, okay, 120K, that's the top. Let me go ahead and sell all of my assets and then just buy them back at the exact bottom. It's the in between. I'm going to take the capital that I received from selling my coins at 120 and I'm going to do something with it. And that's really the power of DeFi. And again, I'll get into the strategies and the nitty gritty, but that's the message I want to mainly focus and deliver tonight is in DeFi, you have the ability to not just invest in quality assets that will go up over time, but while you're waiting for that price appreciation to happen, you can generate daily cash flow. That is the key. And that's going to be one of the main strategies. And that'll be the key for why a DeFi operator with all of these strategies and capabilities will massively, massively outperform these traditional investors. Buy assets and sell. Like a traditional investor, they're going to buy stocks. Maybe they buy Bitcoin. Maybe they even buy ETH or Solana or SWI. But they buy and then they just hold onto the assets. And that's our key audience. And for our business for overseas DeFi is folks who own crypto. Maybe you bought Bitcoin at 60K or maybe 59K just recently. Maybe you bought Bitcoin even cheaper than that. But if you're just sitting on your assets, not doing anything, not making those assets productive, you're leaving thousands of dollars on the table. So definitely I'll get into the strategies and like I said, the nitty gritty of how do you actually do that. But that's the power of DeFi. It's a two-sided approach. Number one, of course, we're investing in crypto assets that we believe in, Bitcoin, ETH, SWI, Solana. But the other part of it is we actually use those assets the way they were meant to be used, especially ETH. Ethereum is the original smart contract protocol. And most people, first of all, they never even take custody of the coins they bought. They leave their coins on Coinbase. But secondly, even if they bought ETH, they don't make use of all of the smart contracts and all of the protocols and all of the wonderful opportunities that we have in DeFi. Ethereum literally was invented for DeFi. It's the main smart contract protocol. DeFi is basically a collection of smart contracts and different protocols online where you can exercise these different strategies with your assets. So take custody of your assets. That's the first step. We take custody of our assets here. Everything we do in DeFi is strictly self-custody. We're not sending our money to a centralized exchange. We're not sending our money certainly into some kind of black box investment scheme. We take possession, we take custody of our assets, and we actually use those assets in DeFi to generate extra income. And the way it works in DeFi, it's daily. You get daily cash flow if you know how to set these things up. Now, before I get into the first strategy, I do want to just give a little bit of a plug for our YouTube channel. Let me bring it up over here. Because recently I've been creating some different videos where you can watch these videos, and there's only I guess there's only 3 of them so far. I'm almost finished with a 4th video, so I should be publishing that hopefully tomorrow. But if you go onto our Overseas DeFi YouTube channel, you can take these little videos as they're basically like little courses. So you can watch these videos for free. I'm not asking for anything from anybody. Here is you can just watch these videos. You can learn about self-custody. You can learn about how you can save 99% on your crypto trades versus Coinbase. You can learn how you can borrow capital for 4% interest. Forget about 7% mortgage interest, 10% car loans, and 30% credit cards. In DeFi, we borrow capital for 4%, thereabouts. And then the sort of the flagship opportunity here, get paid every day while you wait for those long-term narratives to play out. That's the secret sauce, if you will. You invest in these assets and you literally get paid to wait for those assets to appreciate in value. Okay. Now, let's get back to this argument, because he and I went back and forth for quite some time, and like I said, it was what gave me the idea to present this and what I'm going to be talking about tonight. So let me lay out the assumptions. Okay. So first of all, this guy's story was, hey, I know these guys that they just sold all their coins at 120K, and then they bought it back at 60K. And now when it goes back up, they're going to have 100% return on their money. And that was so much better than DeFi. Okay. So the caveat and the assumption here is that give me the exact same timing. Let's say that I know in advance, or I had the same foresight as these guys, which is freaking the trade of the decade, right? You sold Bitcoin at 120 and bought it back at 60K. Like, congrats, good job. But if you give that same exact market timing to me, let me show you how I can outperform. So the first strategy has to do with decentralized lending and borrowing. This is a very important capability or service that we have within DeFi that you can't get from your E-Trade account or your Charles Schwab or any of your traditional brokerage accounts. Strictly in DeFi, we have the ability to lend and borrow assets. And I'm going to start out with the example, and I'm going to show this in our app. So this is the Overseas DeFi app. If you join Overseas DeFi, you get full access to this app. There's an AI bot that's completely trained on all of our workshops and strategy sessions and Q&As and open office hours and all of our strategies, all of our frameworks, everything programmed into this DeFi brain. So you can ask a question at 3 o'clock in the morning and get a pretty good answer in terms of how you're continuing to build up your DeFi portfolio. And importantly, you get your portfolio tracker. This allows you to look at your spot positions, your liquidity positions, your lending and borrowing positions, even perps. If you trade the crypto perps, you can get that into the tracker. Recently, we released the fee tracker app. So the spreadsheets, if you're already a liquidity provider and you've been keeping your records in a spreadsheet, you can kiss those goodbye. The fee tracker here keeps track of all of your liquidity positions and day to day, the fees you collect, and most importantly, shows you your average yield. So what are you yielding? What are you earning over time on your liquidity position? So all of that is built into the fee tracker. What I'm going to focus in for strategy number 1 is the lending and borrowing tab. So if you go to the top of the portfolio tracker, you go into lend borrow. This is just a demo wallet where I have this tiny position. This is basically my main lending and borrowing position. I have about $97,500 in collateral. At the moment, about $63,000 or $64,000 borrowed against that collateral. So here's the first part. This guy said, these guys, my trader friends sold their Bitcoin at 120,000. So I've already configured this little liquidation test that we have. This is, again, this is built into the app. It allows you to fully play around with your lending and borrowing position and play out different price scenarios. And then you can see, where you would get liquidated, the gains you would make, the losses you would have, etc. And I'm going to use this in a bearish configuration. Now, let me back up a second. If I buy ETH and Bitcoin and I lend that on a protocol like Aave, okay, here's my actual position. There's my collateral. There's my borrowing. Generally, the idea here is to be positioned long, to be configured in a bullish way. What does that mean? So long term, I believe ETH is going higher. I believe Bitcoin is going higher. So those are the assets I want to hold on to for the long term. So when I'm doing my lending and borrowing, the lending, those are my long-term assets. And you can see I've configured it exactly like that. ETH, I lent that to the protocol. Don't worry about I am earning a small interest rate. That's not the great thing about this. It's just it's a little side benefit, but I'm lending those volatile assets that I believe in long term on my collateral side. On the left side here, these are the coins that I've supplied to the protocol. Coinbase wrapped Bitcoin and ETH for the most part. And disregard this ETH loan right here. Imagine I had only borrowed USDC. What is USDC? It's a stable coin. Each and every token is pegged to a $1 value. So it doesn't go up and down in price. Now there's that 4% interest rate I talked about. I've literally borrowed money from Aave, paying at the moment 4.24%, and I used that money, that borrowed money, I off-ramped it and paid down one of my credit cards because they were charging me 30% on the credit card. So if I lend volatile assets and I borrow stable coins, that's a bullish configuration. Imagine, let's just use easy numbers. Imagine I put $100,000 of Bitcoin and ETH on the left side, and then I borrow $50,000 in USDC on the right side. Then a big rally comes, and my ETH and Bitcoin appreciate, let's say, 50%. So if Bitcoin and ETH appreciate 50%, suddenly my $100,000 in collateral appreciates to $150,000 of collateral, right? Now, these coins are still mine. I could just pay off the loan and withdraw those coins if I wanted to sell them. But that's what would happen if it was a bullish environment, okay? My collateral on the left side would appreciate in value. Well, what's happening to my loan? My loan pretty much stays the same. If my loan is based on USDC, the price of a USDC token is always $1. It doesn't go up and down. Now, there is a little bit of interest that's going to accrue to the loan. So if you come back a year later, the $50,000 might now be, well, it would be another 4%. What would that be? About $200. So now it would be $50,200. So my collateral went up to 150. My loan pretty much stayed at 50,000 in change. Now my equity, think about this in real estate terms. What if you buy a house for $300K and you borrow $200K? Your equity is 100. That's the difference between your house value, $300K, and your mortgage, $200K. So you've got $100,000 in equity. Well, if it's a good real estate market and that $300,000 house goes up to $500,000, your mortgage is still $200K, but now your house is $500K. Your equity went up from $100,000 to $300,000. Same thing here. If you're configured bullishly, and this lending and borrowing position, this is unique to DeFi. This is fully configurable. It's fully customizable, which is where we're going to get into the first strategy. But I just wanted to explain the sort of the normal configuration. If you're like me and you believe in these assets long term, you're going to lend the volatile assets, those appreciate in time, and you're going to borrow stable coins, which your loan balances over the years, it's going to stay roughly the same. It's only going to go up by 4%. Think of it another way. If I collateralize Bitcoin and ETH, and those assets appreciate more than 4.24% per year, I literally never have to pay back this loan, right? That's all. That's the carrying cost. Like I could theoretically never pay back this loan. They call it a self-paying loan. If your assets appreciate at anything faster than 4.24, let's say 5% per year, you're golden. Your equity just keeps increasing year after year. As a matter of fact, if you have a good year and the assets go up 100%, which Bitcoin and ETH definitely can do that in a good year, not only are you not paying back that loan, you're actually going to be able to borrow more safely, as long as Bitcoin and ETH don't crash. So there's management that goes into that. You do need to keep an eye on your risk. You keep an eye on your health factor. You keep an eye on your loan to value ratio. You got to make sure you don't get liquidated, which is why I've customized my debt to actually include some ETH debt over here. We'll get into that. Okay, but the normal, everything is bullish. I believe in these assets. You're going to lend your volatile assets and you're going to borrow stable coins. And then as those assets appreciate in value, your equity grows and you never have to, there's no payment plan here. There's no minimum monthly payment or any of that. As long as your liquidation or as long as your LTV is below the liquidation threshold, you're good. Aave doesn't give a damn. Now, let's go back to this scenario. Let's suppose that Bitcoin is trading for 120,000 and I know it's the top and I know that 8 months in the future I'll be able to buy it back at 60,000. Here is what I would do, and this is the first strategy. So I've used our app to simulate this. I put my collateral, as 1 Bitcoin. I don't have perfect resolution on this, so I played around with the price scenario until the price of Bitcoin is about $120,000. Okay, so here's my Bitcoin is $120,000, and actually, I'm going to actually reverse this. So let me add a collateral asset. Hopefully, perfect. It'll allow me to add a USDC asset. So step 1 in this scenario that I had this argument with this guy about, I sell my Bitcoin and his genius trader friends sold all of their coins at close to the top, 120K. So I'm going to make the same assumption. I'm starting with 1 Bitcoin. I sell the top. Now I have $120,000, and I would switch that to stable coins, right? It's in crypto. It's in DeFi. I'm going to trade my 1 Bitcoin for USDC. So let's start with that. So I put the $120,000 USDC into my collateral position. So already you're thinking, well, wait a second, this is different. I thought you want to put your volatile assets on the left side. The difference is here, we're playing out a hypothetical scenario where this guy was going on and on about his genius trader friends that massively outperformed DeFi. And that was the assumption is that, or that was the claim, is that these guys sold their coins right at the top at 120K. So I'm going to do the same thing. I'm going to sell my one Bitcoin. So let me get rid of this, zero that out. As a DeFi operator, what I would do is I would flip that script. If I know in advance that this is the top and Bitcoin is going to go on an 8-month downtrend down to 60K, I don't want my collateral to be volatile. I don't want to hold on to Bitcoin. If the price is going from 120 down to 60, I don't want to hold that. Instead, I want to hold dollars. Okay. So I swap my one Bitcoin, I get 120 USDC, and I load that into my collateral. Okay. So that would be my first step as a DeFi operator. Now, why would I even do this? The genius traders sat on their hands for 8 months. So they sold their coins for 120 and then just sat on their hands. I don't sit on my hands. I put my capital to work. If I had one Bitcoin and I sold it at 120, I wouldn't just sit on the $120,000 knowing what I know and knowing the power of DeFi. And that's, of course, what this whole evening is about. So I put my 120,000 in the collateral section, and now I'm going to borrow capital against it. So let's say, I mean, I could get very aggressive with this if I knew ahead of time, but let's be more realistic. And I'm going to borrow. Now I'm borrowing the Bitcoin. Okay. Now at this point, my loan to value is very safe. The liquidation threshold would be somewhere around 78 to 83%. I don't know exactly what the liquidation threshold is when you're lending USDC, but a 50% loan to value ratio would be very conservative, especially, if we know the price is going to go down. Now watch what happens. I've loaned about $120,000 to Aave, and I've borrowed the 60K of Bitcoin. We will talk about the 60K in a moment. Just imagine here, though, that I'm borrowing $60,000 of capital in the form of wrapped Bitcoin. Now, what happens on Aave? When you borrow, there's no forms to fill out. There's no credit check. There's no waiting. It's 24/7 and it's instant. And what happens when you borrow assets? I mean, I could do it right now. I'm not going to. I could borrow USDC right now up to $12,000. Those tokens come out of the Aave smart contract and they come to my wallet. This is the unlock. This is the magic secret sauce that makes DeFi so much more powerful. Try doing this with your E-Trade account. You cannot. You might be able to get a margin loan, but the rates are probably a heck of a lot more than 4%. And it's not as easy and it's not as quick and customizable like this is. And by the way, in a brokerage account, you can borrow dollars. You can't borrow a volatile asset. Okay. So going back to this scenario, now we're going to have the big price drop. So we'll talk about the 60,000 over here later. I'm going to borrow this Bitcoin. It's going to come out to my wallet and voila, I have $60,000 of capital. And we'll talk about what I'm going to do with that capital as the price is dropping. Now, here goes the price drop. I just clicked this button a bunch of times. Let's make it a little bit quicker. And we're going to go all the way down to roughly 60,000. So this is the other side of these genius traders trade. They sold the Bitcoin at 120 and they bought it back at 60K. So let's just say there. What has happened to my debt? Because I borrowed a volatile asset, I still owe half a Bitcoin. But the price of that, or the value of that half a Bitcoin, is now only 30,000. I got $60,000 of capital out of the protocol and into my wallet at the beginning of this. Then the price dropped, and now the dollar value of what I owe is only 30,000. Okay. There's a couple of different numbers that we'll have to keep in mind, but this is the first part. Now, according to this guy's story, the genius traders bought Bitcoin back at 60,000. And isn't that awesome? They were able to buy back twice as much Bitcoin at the bottom. And now the price is going to go back to 120. And these guys are going to make 100% return on their money. I'm not sure how long that takes to play out, but that's the thesis and that's the argument. What am I going to do as a DeFi operator? Well, guess what? I still have $120,000 of USDC. That's my collateral. And my loan, what it takes to pay back my loan now is only $30,000 worth of Bitcoin. Okay. When I took that half a Bitcoin at the beginning, what I'm going to do with that is use that capital to provide liquidity on the way down. And the way it works when you're providing liquidity and the price keeps dropping, you keep ending up getting converted to the volatile coin. Okay, let me give you an example of this, and then we'll talk about what I'm going to do as a DeFi operator versus what these genius traders supposedly did. Let's look at the Bitcoin chart, and we'll zoom out a little bit to maybe a 4-hour chart. That'll work. So it's we're pretty much talking about this price movement from right in here down to, well, let's just go right there because that's when it hit 60,000. Okay. Now, I'm going to take that half of a Bitcoin. Remember, I borrowed half a Bitcoin and I owe half a Bitcoin. I'm going to take that half of a Bitcoin and I'm going to deploy that into a liquidity position. Let me turn off some of these drawings so hopefully it'll be a little bit less confusing. And again, if you're watching this right now and you're starting getting confused or whatever, please just ask a question in the chat. I would be happy to double click on anything that you're not understanding. I hate to say it, but it's about to get a little bit more complicated. Give me a sec. Okay, so now we just have a plain old chart. The way it works when you provide liquidity, the way we do it is we provide concentrated liquidity positions. That just means that you have to designate a price range for your capital when you provide liquidity. And when you're providing liquidity, you put your tokens into a decentralized exchange. You put your tokens into a liquidity pool, which is just a smart contract. And when traders trade, they're trading your tokens. Let me give you a specific example. I'm just going to use Bitcoin here, although I would probably provide liquidity on something like ETH, where the yields are going to be higher because there's more trading volume and things like that. But to keep this more simple, I'll talk about this in terms of Bitcoin. When you provide liquidity, traders are going to trade. You're going to receive some of the trade fees along with you're sharing those fees with other liquidity providers. But you're literally getting paid when other people trade. That's what makes it such a great business, is people want to trade crypto all day, every day. That it's more beneficial to trade crypto on a decentralized exchange compared to Coinbase or Binance. Literally 99% cheaper than Coinbase on your trade fees. So the traders win. They're paying much less in trading fees, and the liquidity providers win because the liquidity providers are the ones that are collecting those fees. It's like you get an opportunity to be Coinbase. That you can think of it like that. I'll go back to this. Now, if a trader swaps Bitcoin for USDC, they're sending Bitcoin to the pool, and the pool sends back USDC. Now, all of that is automated. The smart contract handles all of that. You don't have to do anything other than put your tokens into the pool. But think about it from the other side of the spectrum. A trader is selling Bitcoin physically. I mean, this is all intangible, but literally what's happening on the blockchain is the trader sends Bitcoin to the pool, and the pool sends USDC back to the trader. So they just sold some Bitcoin to get USDC. Or to be more accurate, they swapped Bitcoin for USDC. They sent the Bitcoin, they got the USDC. The liquidity providers are on the other side of that. We're on the opposite side of every swap as a liquidity provider. So if a trader sells, our liquidity position is the one buying. We send the USDC to the trader, and the trader sends their Bitcoin to us. Right? Now, again, all of it is handled automatically by a smart contract, but that's how it works. So think of it like this. If traders are selling and selling and selling and selling, what's our liquidity position doing? Buying and buying and buying and buying. Okay. So what's happening right here, because the price went down, is traders are selling. On balance, they're selling Bitcoin here, which means our liquidity position, which I've marked with this rectangle, our liquidity position is going to buy Bitcoin all the way down. And if I just kind of ballparked a range here of, again, we provide concentrated liquidity. So we have to designate a range of price where our capital is going to be used up. By the time the price drops down here to the bottom of the range, we don't have any more USDC in our position. We already spent all of our USDC. The traders kept selling, so our liquidity position kept buying Bitcoin all the way down. But by the time it reaches the limit, we're out of USDC. Our position is now 100% Bitcoin. So let's go back to that half of Bitcoin that I borrowed. Genius traders, they sat on their cash. They sat on their 120,000 for 8 months. A DeFi operator puts that $120,000 to work. I put the 120K into my collateral and I borrow half a Bitcoin. And then right here, let's zoom in here. Let's say it's this day right here, and the price is up here, okay? And, or maybe it's, just right there, 120,000 and change. Okay, I just sold my one Bitcoin. I just put my USDC into Aave, and I just borrowed my half a Bitcoin. Now I'm going to use that borrowed capital to generate daily cash flow. And this is the other part of our playbook, our toolbox here. The two main strategies in DeFi are decentralized lending and borrowing, which unlocks extra capital with a low interest rate. And then the second part is providing liquidity on a decentralized exchange. Now, the fees that we can generate daily with these LPs, my experience as a, you could say, professional. I've been doing DeFi professionally since I quit my job in January of 2022. I'm not trying to brag, but my experience as a seasoned, let's call it that, liquidity provider is that I can generate, I've generated about 10% per month. That's my experience as a liquidity provider. Now, sometimes it's actually higher. Sometimes it's much lower than that. I would say that on average, my own yield performance as a liquidity provider. Now, I'm not talking about 10% of my whole portfolio. I'm talking about the capital that I deploy into a liquidity position. That liquidity position, I've been able to generate about 9 to 10% per month, usually somewhere between 100 and 120% APR. That's the yield that you can expect of a well-managed liquidity position. Now, there's some things that we can do to accentuate that, and there's some things that we can do to be more conservative and less management time and all of that. So there's a whole learning curve behind providing liquidity. But let's be even more conservative. Let's say that I'm able to earn 5% a month on whatever capital I deploy into a liquidity position. Okay. Now I'm just going to give you an example here. This is a very conservative liquidity position. I think this has been open for several days now. You can see all my fee collections. I have about $9,400 in this position at the moment. And Revert is telling me that the average fee APR, the yield on this position is about 66%. Now, there's other things happening here. This $9,400 is actually not all of my money. I actually borrowed capital over here to boost this. The actual capital that I have at risk in this position is closer to about $5,000. So the fees that I've collected, the APR is actually higher than that, but this is conservative, and anything better than 60% APR, that's 5% a month. Okay. Now this position down here, this is a more volatile asset. I'm providing liquidity for Venice. If you've heard of the AI project called Venice, the token is VVV. It actually trades on Base. And right now I'm providing liquidity. This position has only been open a few days, but my fee APR on this is about 15% a month. 180%, that would be 15% per month. So this kind of gives you an idea. This is going to go up and down. This is not a constant thing. It's definitely not a guaranteed thing. But again, in my experience, I'm going to be able to generate with that borrowed capital that I plug into a liquidity position. I'm going to generally be able to generate maybe somewhere 5 to 10% a month. But let's be super conservative. Let's say I'm going to be conservative, and all I'm going to do is generate 5% per month on that initial chunk of capital. Okay. Now, as the price drops down, well, actually, let me back up a step. In order to deposit this liquidity position when the price is up here, remember I borrowed half a Bitcoin. Now the question is, how do I deposit that money into this position? Well, again, traders, our liquidity position does the opposite of what traders do. So if the price is here, it's not even in my range. The price right up here is above my range. And so if I'm going to deposit my tokens into a liquidity pool for Bitcoin and USDC, and the price is above my range, what do I need in my position to interact with the traders? Remember, if traders are selling, which is what's happened right here, when the price goes down, it means majority of traders are selling, okay? So as the traders are selling, what is my liquidity position doing? It is buying. If traders are selling, my LP is buying. How do I buy? Well, I need USDC. That's what the traders want. When they're selling their Bitcoin, I'm taking it in and I'm paying in USDC. So what that means is that when the price is up here, I need to stock my liquidity position with 100% USDC, right? And then when the price dips down and it enters my range, that USDC in my position begins to be spent buying Bitcoin from the traders. That's how a liquidity position works. And I've explained this in recorded videos. You don't have to sit here and watch a 60-minute live stream to learn how to do, but I don't get into this much detail. You can't get into this much detail on a 10-minute or 15-minute video. But that's what's happening inside my liquidity position. Because I start the position when price is higher, I need to stock or load or deposit 100% USDC into this range. Okay. Now, what happens when the price dips down? My position begins to buy Bitcoin from the traders. Okay. And it goes down. And by the time the price is all the way down here, all of the USDC is gone. It's all been spent. And now when the price escapes the bottom of my position is now 100% Bitcoin. So it's completely converted. It started as USDC and then converted fully to Bitcoin. Now, let's think about the trading there. Now, I understand you're going to go, some of you might be thinking, well, that's a massive impermanent loss. And that's true. The value of the position is going to drop. But I want to keep in mind the tokens here. Okay, because remember, I borrowed half a Bitcoin back when the price was 120K. So if I sell that half a Bitcoin, I'm going to get $60,000 when the price is up here. When I'm getting ready to deposit this liquidity position, I need 100% USDC. So I have to swap the full half a Bitcoin into 60,000 USDC. And I load that 60,000 USDC into this liquidity position. Now, as the price is dropping down, am I going to buy back half a Bitcoin? I'm actually going to be able to buy back more than half a Bitcoin because I sold half a Bitcoin here. I got $60,000. But as the price drops, I'm buying Bitcoin from the traders at lower and lower prices. So that $60,000 goes a little bit further than just half a Bitcoin. Now, I don't know exactly what it would be, but my point is it's actually going to be maybe a little bit more than 0.5 Bitcoin. Okay, now it drops here. Now it bounced back up. Okay, great. And I'm collecting fees. I'm collecting fees again to the tune of maybe 5 or 6% per month, collecting fees anytime it's in my range, yada, yada, yada. Now it finally drops out for it. Okay, now I see this. And you're not going to be able to manage this perfectly. But here's the point. When the price drops here, I'm holding more than half a Bitcoin. So I still have my half a Bitcoin plus a little extra, plus whatever fees I generated. That's extra. the fees are above and beyond the fact that you have half a Bitcoin or a little bit more than half a Bitcoin. The fees are extra. And again, somewhere around 5% a month, being conservative, okay? So once the price drops for good and it's spent, I don't know, 8 hours or 12 hours below my range, now I'm going to adjust my range. And the way I would do this is with what we call a snuggle. So I'm just going to make a copy of this guy. And again, assuming I have this perfect market timing that the guy was telling me about, I'm gonna snuggle my range down. I don't want to sell. I don't want to sell any Bitcoin. Okay. Now, if I put my range down like this, the old position is 100% Bitcoin, right? My position spent all of its USDC and it got converted fully to Bitcoin. But this position here, if the price is right in this neighborhood, let's make this even easier. Let's say I move my range like that. And let's say the price is right here. Think about this for a second. If the price is right here, and this is my liquidity position, down here, I need USDC, because if the price goes down, I need to buy Bitcoin from the traders. Up here, I need Bitcoin, right? Because if the price goes up, I need Bitcoin to sell to the traders who are buying. So I would have to convert or rebalance my position from 100% Bitcoin to 50-50. I would literally have to sell Bitcoin at this price and hope that it wasn't the bottom, because you never want to sell the bottom, right? So if I had perfect foresight and I knew the price was going to 60,000, then maybe I would act differently. But I'm trying to be more realistic in what I would actually do with my liquidity position is I would snuggle it down. So what that means is that I'm going to move the range close to the current price. Let's say the price is right here, where the range is still, it's closer to the price, but it's not overlapping the price. And if the new range is completely above the price, then that new position is also 100% Bitcoin. So the old position, 100% Bitcoin, the new position, also 100% Bitcoin. So there's no rebalancing needed. I literally just withdraw my 0.52 Bitcoin, or whatever it is. I withdraw it from the old position and I deposit it into the new position. And then whenever the price bounces a little bit, like right there, or right there, or right there, it has to be in my range to generate fees. So I snuggle it down. I don't start generating fees right away, but every time the price bounces a little, I generate some more fees. Okay. And so that keeps going. And then one day it drops and just keeps on dropping. So I rinse and repeat. I do another snuggle. Let's say right there. Now, when I withdrew the 0.52 Bitcoin from this position and I loaded it into this position, like I said, withdraw and deposit, both 100% Bitcoin. So I don't lose or gain any Bitcoin. I'm just moving my 0.52 Bitcoin down the chart every time I do this snuggle adjustment. When it bounces, some of that Bitcoin is being sold to traders, but then when it drops back down, that same USDC that I generated gets spent again, and the Bitcoin gets bought back. So there's no change in the balance of my LP. Here, I loaded it with 60,000 USDC. And because the price went lower, I was able to buy a little bit more than half a Bitcoin back on the market because traders were selling it to me at a lower price. So I'm just estimating it's going to end up being about 0.52 Bitcoin. Then the 0.52 Bitcoin goes from here to here, and it goes from here to here. And I didn't catch much of a bounce. So pretty soon I'm like, well, I need to move my range down again. So I move my range down again. I catch a little bit of bouncing. But the Bitcoin gets sold and then it gets bought back. The Bitcoin gets sold and it gets bought back. Every time the price escapes the bottom of my range, I have the same bag of Bitcoin. Okay, so I got to wrap this up because I'm already pretty long into this video. Here's the key point. 2 key points, actually. Number 1, I started this position by borrowing half a Bitcoin. I swapped it and deposited the capital into a liquidity position that paid me, we're going to assume 5% per month. And every time the price went lower, my position kept getting converted into 100% Bitcoin, and it kept being 0.5 and change Bitcoin. So the half a Bitcoin really didn't go anywhere. It just traveled down the chart. And so then when the fateful day comes and it's my opportunity to buy Bitcoin back at 60K, copy and paste. When, the day that Bitcoin finally arrives at that magical $60,000 number that I knew it would, I still have that 0.5 Bitcoin in my liquidity position. Plus, I've generated fees all the way down. So the 8 months where those guys were sitting on their hands, just sitting on cash for 8 months, I've been making it work for me. I've been using it to generate fees. That was a good bounce. So if I snuggled my range down there, I caught a lot of price action. Eventually it went lower, right? And then we hit 60,000. So let's say the final position is something like that. Generate some more fees, and then it's time to reverse everything. So 60,000 is what I borrowed. And I'm going to multiply that times 5% per month. So I'm generating about $3,000 a month in fees. Again, that's being very conservative based on my history and my experience and what I literally showed you as the couple of liquidity positions that I'm running right now. But I want to be conservative. So $3,000 a month times 8 months, I'm going to have $24,000 extra in fees. And I still have my half a Bitcoin. So here's the unwind. I come back to my Aave position. And as far as Aave is concerned, what's my loan? It's half a Bitcoin. How can I pay back the loan? With half a Bitcoin. So I take that half a Bitcoin out of my liquidity position, never mind a little bit of extra that I have, and I just pay off my loan. So this goes to 0. So now we're at Bitcoin 60,000, and I pay off my debt. This 120,000 USDC is still sitting right there. the half of Bitcoin that I made work for me all the way down for 8 months, it has generated $24,000 extra. Now, again, perfect market timing. And that was the guy's story. Whether or not I believe him, that's another thing. But with perfect market timing and knowing that we're on our way, we're on this journey from 120K down to 60K. Every time I collect fees, I get some Bitcoin and some USDC. What am I going to do? Bitcoin hasn't dropped to 60K yet. I'm going to sell those fees for more USDC. The Bitcoin portion of my fees, I'm just going to sell that. I'm going to collect that USDC. So at the end of this 8 months, we've got an extra $24,000 in USDC that I generated off of the borrowed capital. The little bit of extra Bitcoin that I have, because that original liquidity position bought more than half a Bitcoin back as the price went down to the bottom of the range, probably that's going to be more than enough to pay off the interest. Like on Aave, I can borrow Bitcoin. Look at the interest rate. Talk about cheap capital. I can borrow capital at less than 1% per year interest right here. These coins come out to your wallet. You can swap it for USDC. You can swap it for Solana. You can swap it for anything you want. Okay. And you're only paying, look at that, 0.77% interest on borrowed Bitcoin. So I don't owe too much more than that 0.5 Bitcoin. My original liquidity position more than covers it. That half a Bitcoin just keeps traveling down the chart. It stays as half a Bitcoin. I pay off my loan at the bottom. I still have the 120K. Plus now I also have 124, or excuse me, I have an extra $24,000 conservatively that I generated in fees on the way down. So I got to wrap it up, but that's kind of the end point there. Is the genius traders, they sat for 8 months on their cash. Yeah, they had awesome timing. I wish I had the same market timing. Unfortunately, I didn't get bearish on Bitcoin until late November, when it was trading for, somewhere in the 90s, between $90,000 and $98,000 in late November, early December. That's when I got bearish. That's when I started shorting. That's when I started hedging and all the rest, and generating some profits as the market moved down. But if I had had perfect market timing like these guys, the extra $24,000 that I would have earned, that's how DeFi absolutely crushes traditional investing. And then if we want to follow it through to the final example, those guys, they're going to buy the bottom at 60,000, but all they have is 120,000. So they're going to be able to buy 2 Bitcoin. For me, I still have my 120,000 plus the extra 24K. And if I divide that by the $60,000 Bitcoin price, I get almost an extra half of a Bitcoin, right? And then it just rinse and repeat on the way back up. Again, if we had perfect market timing, we could absolutely crush it. You're never going to be able to time the market perfectly, regardless of what this guy was saying about these traders. But if you make your assets work for you, and if you feel like, if you believe that we're going to continue down, for example, a lot of people, even now that Bitcoin is massively sold off, they're still calling for much lower prices. Some people are calling for 50 or even 40 or 30 something $1,000 Bitcoin. I'm not in that camp. A week and a half ago, I came out on this channel on the live stream saying I think the bottom is either in or it's very, very close. I could imagine another drop, maybe down to $56,000, $55,000 Bitcoin. I really, really feel strongly that it won't go much lower than that. So for me, the bottom is in. or very, very close. And this is now when I'm starting to re-customize and reorganize my lending and borrowing back to a bullish stance. You can see I still have a short position. So this is a short position, or a synthetic short position, where it actually helps me when the price goes down. If I borrow USDC and my collateral prices go down, I'm just losing money. But if I borrow ETH and the price goes down, yeah, my collateral is losing value, but my loan balance is also dropping. So it's a little piece of my portfolio that actually benefits me when the price moves down. And I manage this not on a daily basis, but literally just this morning, I bought one more ETH for 1650. And I paid down some of this debt. So I'm slowly unwinding my synthetic short positions on the Perps exchange. I'm actually long right now. I think that we're going to get some sideways price action, and I believe that between 1600 and 1650, I think is a pretty good buy point on ETH. But yeah, that's how I manage things in DeFi. Didn't see any questions in the chat, although we do have quite a few viewers in there. So I would be willing to spend a few more minutes if anybody has a question on lending, borrowing, providing liquidity, perpetual futures trading. This is a decentralized exchange called GMX. Any questions at all? Give you a second. Well, I appreciate those of you who tuned in. If you're watching the recorded video, thank you. Make sure to like the video, leave a comment down below, subscribe to the channel, and most importantly, turn on notifications. I'm going to switch it up. I'm going to start doing these live streams every Tuesday night instead of Thursday night. So Tuesdays, 6 p.m. Eastern, I will go live, and you can ping me with any question you want. I mean, as long as it's about crypto and DeFi, I'm happy to answer questions. So there's no need to spend anything. You can learn everything you need to know about DeFi and start benefiting from these protocols and these opportunities within DeFi for free. All it takes is just learning a new skill. So I don't see any questions. Yeah, I hope to see you all next week on Tuesday, 6 p.m. Eastern. Until then, thanks for watching. Bye-bye.